Hello everybody, welcome to MarketStream.live. My name is Joseph Cusick with the Cusick Group, security offered by Money Block. Here with Strategy Now. This is where at the 12:30, 1:30 Eastern Time, 12:30 Central, we come in and we talk about some strategies. And with the market basically grinding right now at these now all-time highs, coming off of those levels, it's really hard to deploy capital, especially with the geopolitical, the economic, the earnings, all of these different, the headline risk, all of these different components. So I thought, why not talk about doing a strategy called a diagonal? Yes, it is using options. For those of you that are new, don't worry, I'm going to go through the mechanics of all of this. But the concept is that you want to take your sentiment, whether you're bullish or bearish, and you want to deploy capital. And I'm going to look at a name that already has had earnings, so we don't have any binary events other than what's happening in the outside market, but nothing specific to this stock, and it's McDonald's. Now, after earnings, it had earnings on the 24th, the 24th, and of April, this week, and it's popped up. And it's done quite nicely. As a matter of fact, this is a 30-minute chart. So you can see that the stock has just skyrocketed after the last couple of days. Now, you're still bullish on the stock, but you're sitting here thinking, well, it's got this gap. It may pull back. There's a lot of people that didn't get involved with McDonald's after what was a good, solid earnings announcement. How do you participate for, let's say, the next 50 days so that even if we have a little bit of a pullback here in the next 20 days, McDonald's resumes after maybe testing the 140 level and then bouncing off? How do you do that, but you don't want to buy stock outright? Use a call diagonal. Now, before I jump in and say, all right, let's construct this trade, you're going to buy this, you're going to sell this, I want to set the table. We've already looked at what's going on with the stock. Currently, right now, the stock is pulling back a little bit today on McDonald's. So I like to buy on weakness. Okay, great, check. That's off my checklist. The next thing I look at is implied volatility. Now I'm taking a look at an implied volatility chart. I'm going to clear off these two lines, and I'm just going to look at the green line. And basically the implied volatility is trading at a level of 10. Now, what does that mean? Well, first of all, to give you context, the average for the last 52 weeks has been right around 1327. So if you see the implied volatility is running at 10, that's telling you that IV is running low. As a matter of fact, it's running very low. The IV rank is going to be extremely low. And that's represented versus its average. Now, there is a few anomalies in here, so it might be skewed a little bit, but we know that there's not a heightened sense of huge moves going into the May expiration cycle. That's what implied volatility is telling me. This really starts to help me think about how I'm going to construct this trade. It also tells me that doing something like a diagonal strategy, which is where I'm using a call option that is going to be expiring, let's say, in 50 to 60 days as a proxy for long stock, so it's going to be in the money, and I'm going to sell another option against it. Because if you watch any of my videos and you start hearing about how I like to invest, I want to pay less than what the prevailing market is offering, or I want to sell at a better price than what the prevailing market is willing to buy it for. And so how do I do this in McDonald's? Well, let me give you the mechanics, because remember, what are some of the checklist components? One was, I have a sentiment on a stock, McDonald's. I am bullish over the next, let's say, 35 to 50 days. Okay, so I'm going to look at options that have expirations between now and June. I want to have a fixed risk. In other words, I want to be able to say, I know how much I'm exactly going to be risking. Well, that's why I'm using the option. And if I buy an option, the debit I pay for it, that's all I have at risk. Check. Second thing that I want to do, or third thing, is I want to offset that purchase price, because remember, I don't like to pay retail. I like to pay wholesale. So I'm going to buy this option. That's my fixed risk, but I'm going to give up some of my upside profit potential to reduce that risk, and I'm going to sell an option, but the expiration of that option is shorter than the option I'm buying. So it's going to roughly have somewhere between 20, 25 days to expiration. Okay, so I'm going to be looking to buy in June in the money. So the stock right now is trading at 141. I'm going to look at the 140 level to buy. I'm going to look in June. In May, I'm going to look, and let's actually just set this up. And then what I'm going to do is I'm going to look to sell an option. Let's say, I'm going to display the Greeks. Again, for those of you that are options traders, don't worry. We're going to walk through this. What I'm going to do is I'm going to look at the May monthlies and the June monthlies. So this gives me 25 days in May, or 22 days in May, and roughly 50 days in June. So the June 140 calls, they have a delta of right around 60. They're trading at 283 at 305. So I buy these for $3.05. That means that my maximum risk to have a right to own McDonald's stock at 140 is going to be $305 per contract. So I have to pay $305. Now, to offset that purchase price, I'm going to sell the May 144 calls. Those happen to be about a 28 delta. And I'm going to collect 62 cents. So that's going to reduce my cost basis by that amount. So if I scroll up, you're going to see that I am going to be buying the 140 calls that expire in 50 days, in other words, in June. So that gives me 50 days to be right for the stock to trend up. Even if it pulls back, I still have time to be right. Now, to offset that purchase price, I'm going to sell the May 144 calls, and I'll receive 62 cents. So that reduces my cost basis of 305 by that amount. So in other words, I'm going to pay roughly right around 240, 243 if I bought it based on buying on the bid offer and selling on the bid. But I'm going to actually work an order where I only want to limit $2.30. Now there's something about diagonals for those of you that have traded these before or are now starting to trade these. The width of this spread is $4. Difference between what I'm buying and what I'm selling. I never want to pay the debit more than 75% of that spread. Okay, so in this case it's $4. That's the width of the spread. So basically, just to do math quickly in your head, $2 would be 50%, right? That would be a perfect price for this spread. Anything below 3 is going to be a solid purchase price. It allows me to have upside profit potential. As a matter of fact, if in fact the stock between now and May expiration goes to 144 and stays there, that would be my maximum profit point, and that would be roughly around $230, $238. It all depends on a few other components like implied volatility, things of that nature. Now, I'm only going to work this day order only because it allows me an opportunity to keep taking a look at it if I don't get filled today. So let's break this down. I'm going to buy the June 140s. Those expire in 50 days. That's my proxy. In other words, that's why we call it sometimes the poor man's cover call. That's my proxy to buying stock. So I'm going to buy one contract. It's in the money. I'm going to sell the 144 calls, but they expire in May. So basically between now and May expiration, the next 22 days, I have profit potential in the 140 calls up to 144. After that, I stop making money. If the stock goes flying through it, right, after it just goes up to 150, I'm not making any more money on the 144 call. Now I have an offset. I have it covered by the 140 call, but I'm going to stop making money. So my maximum profit point really is that 144 level. Place the order, and that's it. You've now placed your first diagonal. You're taking your bullish sentiment. You want to have a fixed risk. You wanted to pay less than retail. And you're going to have time to be potentially right. All right, folks, that is it right now for Strategy Now. As always, you can go to the MarketStream.live site. You can check out all of the premium content on the site by just going to premium content. And as always, if you have any questions or considerations, email info@MarketStream.live, or you can email me directly, jcusick@moneyblock.com. All right, I will be seeing you at 3:30 Eastern Time, 2:30 Central, where we're going to be talking about Microsoft, Google, and Amazon. I'm going to give you the potential moves in those stocks going in advance of their earnings tonight. See you then here at MarketStream.live.